we do this on occasion, and it's great to be able to learn from people who are working in this space day in and day out. We've been partnered with AB Bernstein for a very long time, and have the great privilege of being able to leverage all their analysis, everything that they do. He's always a resource to Keiretsu members. So please do keep that in mind. So I've had the great joy of knowing Troy now for almost a decade. I think you've known Nathan longer, but it's been a pleasure being able to work with you, work with AB Bernstein, and really help to support our investors as they move through different times, whether it be through the booms and the bear markets or the bull markets and things we need to take into consideration. And this is why we diversify as a group, because there is ups and downs to market cycles, and we need to be able to take that into consideration. That said, we sit in a very interesting place right now in the world and in history. And so I look forward to getting some of your insights, Troy. So without further ado, I'm going to turn it over to you. I'll let you share your presentation and get to it. So thanks for being here.
Great. Well, thanks for having me as always. I'm really excited to share. And as always, thanks for having me. For those of you who don't know us, let me just take a quick minute. We're exclusively focused on doing research around the world, to use that knowledge to design, build, and manage portfolios for our clients. We are a global investment research and management firm. We've got offices in over 25 countries. We manage over $500 billion. I work here out of the Seattle office, one of 20 in the United States. We've worked with private clients for over 50 years. And I'd say one of the things that makes us really different from almost everyone else in our industry are three things that I want you to remember. One is the singular yet global focus, especially as a global firm. The second one is the fact that we're renowned for our investment research. And the third thing is that we are actual money managers. And if you didn't realize, most of the industry are actually primarily distributors of other companies' investment products. And so lastly, one of the biggest reasons clients hire us is for our advice and our assistance, really to help kind of guide them through the complex issues that come with having a lot of wealth. So with that said, let's jump into the data. I'm going to use my handy dandy pen to circle certain areas here. Let's first start on the full year of 2020. You can see it was kind of a wild ride, right? We had a pandemic. At the end of the year, what was leading, you can see right here, was 38% global stock, or U.S. growth stocks were up 38%. That's huge, obviously, especially in the year where the market was down as much. And we also had credit. So these are things like global aggregate, U.S. aggregate, global high yield. They were doing very, very well. And government bonds did well too, munis and U.S. treasuries. And you think, in a world where there was a pandemic, a lot of people left the equity markets and put money into cash. We had over $4 trillion in cash money markets by the end of the year. And they went into bonds, more safe havens, worried about what was going on. Real assets, commodities, global REITs, people tended to get out of them a little bit here as they search for some good return, which was interesting. In a crazy cycle, you'd think that they would maybe head more towards those safe havens. And you can certainly see year to date, that's right here, where they've definitely gone into those. Those are really leading, at least as of the end of June. I don't have the updated data yet to present to you, but they were certainly leading in the market year to date. What's also unique to show you here is what was leading on the equity side, and that was U.S. value stocks. And those stocks tend to do fairly well, in a recovery cycle. For those of you who don't know, value stocks typically do better during inflationary periods also. Value stocks are stocks companies that you can go to in times of distress. You look for the value of the company. Often these are financial companies and things of that nature. You can see there was the reversal in global credit and the reversal in government bonds. That's really because if you looked at the fact that we had interest rates drop to nothing, people were looking for other ways to find areas to increase that yield. And so let's continue on and talk about some other things that have done well. Diversification certainly matters. And I've got here from August to the end of June and year to date, again, as of the end of June, small cap stocks have done really, really well. They were powered back in the fourth quarter after trailing large cap stocks for several years. As you can see here, also growth stocks that did really, really, really well for a number of years. And the recovery is actually still happening. So growth companies definitely outperformed over the last 4 years with the challenging economic climate made during earnings where growth was exceptionally scarce. I'd say low interest rates also help growth companies. And those tend to generate cash flows in the more distant future, and they benefit as lower discount rates make the valuation of those cash flow streams much more attractive today. Even the uncertainty of the pandemic led a lot of investors to continue flocking to large growth-oriented companies. Really, I think for their perceived safety. They'd done well for so many years, they thought those might be safe havens. But risk appetites seem to be changing with the improving economic climate. You can see on the far right there, small cap stocks and value stocks have definitely led the way. I think those are solid businesses that are showing real earnings power. Earnings power certainly helps explain the recovery of the small cap and value stocks later in 2020 and so far year to date. Early this year, a lot of investors had shunned these stocks among fears that they were really more vulnerable to, I'd say, the consequences of the pandemic. But in fact, many navigated the crisis better than expected. And the sales and earnings in many of these companies recovered more quickly than expected after the initial pandemic shutdown. We see a change in leadership so often that it's really impossible to predict. And so keeping a balanced and diversified portfolio is really the best advice. If you look at small cap, you look at here on the screen, small cap, value stocks, even international stocks, non-US, those are really as inexpensive in comparison to their competitive peers as they've ever been. So in a recovery cycle, which I'll say we're still in today, those tend to outperform and do really, really well. Now let's talk about a few 4 key areas I'd say of marked improvement in many areas. Let's start up here with fiscal policy, then we'll make our way to the right. Fiscal policy, most of you know what that is, but that's the means by which our federal government adjusts its spending levels and tax rates to monitor and influence, the nation's economy. The COVID-19 certainly pushed the U.S. stock market into the bear market territory by the end of March 2020. The S&P didn't recover to pre-pandemic levels until late June. And then the U.S. unemployment rate rose, I think it was as high as almost 15% in April 2020, and that was the highest we had seen since the Great Depression. The unemployment rate was about 5.2% or so in the U.S. as of the end of August this year. And the national economy, and that's measured by real inflation-adjusted GDP, fell by about 3.5% year over year. Now, the U.S. government responded to the crisis, as we all know, when it enacted a number of policies to provide fiscal stimulus to the economy and really to relieve those that were affected by the global disaster. And so the government enacted several laws, as we should be aware, to provide relief to businesses and individuals. That included the CARES Act and the American Rescue Plan. I think it was passage of the stimulus package brought about a total of nearly $5 trillion to the pandemic relief tab. So, by the way, in these arrows here, the black one is where we are today. The gray one is where we were about a year ago. So since the pandemic started, they're still continued with this fiscal stimulus. Now let's talk about monetary policy. As most of you know, that's a set of tools that a nation's central bank has available to promote sustainable economic growth. And you do it by controlling the overall supply of money that's available to the nation's banks, to its consumers and businesses. And so if you look over here, we are in easy monetary policy territory. We were a year ago, and we still are today. And that's a monetary policy that increases the money supply, usually by doing a couple things. One is by lowering interest rates, and two is through quantitative easing. And that's where the Fed purchases longer-term securities from the open market to get money back into the supply. Those steps have encouraged lending and investment, certainly. It's led to increased economic growth, and that's what we'll talk about here in a second. But really, I think before we talk about it, if you look at the last week's Federal Open Market Committee, they took another step towards tapering its quantitative easing purchases. And so, again, that's one of the monetary policy steps. The statement the committee published indicated that as long as the economy evolves as expected, it will soon be appropriate to reduce the pace of the asset purchases. And so Chairman Powell went even further, saying that explicitly the tapering could begin as soon as the Fed's next meeting. And that's, I think, a clear hint to the Fed's intentions that we could reasonably expect to receive far ahead of time. So we believe as a firm that the intentions of the Fed, that they announced a tapering at its November meeting. So to be sure, it's not a guarantee. I heard someone at the beginning talk about the shutdown, and there are things that definitely, like the shutdown, could knock them off course. It could be a debt ceiling debacle. It could be renewed COVID disruptions. But I'd say for all other purposes, normal data fluctuations are really unlikely to prevent a tapering in the next 6 weeks, but it's going to take something dramatic for that to change. Now, let's get to economic activity. The U.S. added about 235,000 jobs last month, and it was far below the recent trend that many in the market had expected. But while it's definitely a strong performance, I'd say in normal circumstances, the deceleration last month, I would say was relatively a disappointment, especially considering the gains or the pace of gains that we had earlier in the summer. With several million people working now than pre-COVID, it's going to take more rapid hiring than to get the economy close to full employment over a reasonable time frame. And that's starting to happen. We don't think that the number is so weak that it's going to prevent the Fed from tapering later on this year, but we do think it's likely to take a September taper off the table, which we haven't seen. It's almost the end of the month, probably also for October. So we'll see what happens. I'd say the details suggest that the Delta variant of the virus has been responsible for slowing the pace of a lot of these gains in the economic activity. The hardest hit sector was the private service providing, and then with next, or close to within that, was the leisure and hospitality sector. That went from monthly gains of several 100,000 over the last 6 months to a net gain of about 0 jobs last month. That's definitely a high-touch sector. I'd say it's likely to suffer if people definitely don't change their behavior. It's also a low-wage industry in which many workers are going to be unwilling to risk their health unless they're better compensated. I saw a video about it today. Someone was working in some slushy stand, and they were getting pummeled with an angry customer. It's like, what am I doing making minimum wage and have to cope with this? But, the National Association of Business Economists said that these are about a panel of 47 economists. They surveyed, they expect U.S. growth of about 5.6%. That's down a little bit from what the initial expectations were in May, which was closer to around 6.7% growth. They also sharply cut their call for third quarter growth to an annualized pace of about 4%. And that's down from what they thought was going to be 6.6 in May. And so the downgrades definitely reflect the damage that the Delta variant's done. That's also slowed air travel and hotel reservations and some office reopenings. My office just said recently, as a firm, and my office is 100% vaccinated. They're going to have us coming back probably in mid-October. So we'll see what happens. Lastly, let's talk about inflation. So a year ago, we were in deflation territory, and now we are, definitely higher. I'd say the good news is that business economists definitely share the Fed's view that high inflation will prove to be temporary. The economy definitely continues to adjust to COVID. If you look at consumer prices, the inflation is expected to moderate somewhere to around 2.4% by the fourth quarter of next year. US CPI for August, for last month, definitely slowed meaningfully from previous month. The core CPI rose about 0.1% month over month and about 4% year over year, and that was down the previous 0.3% month and 4.3% year over year. It's still definitely going to take some time before inflation falls back to normal levels. And I think that trajectory, of course, is not yet set in stone, but on the September 14th print, they gave some comfort that the peak of inflation was reached earlier in the summer, or at least by the summer's end. Now, there's that 4% that I talked about. It certainly remains well above the Fed's target, and even a gradual deceleration back towards the target should allow the Fed to remain accommodative for at least some time to come, especially if inflation expectations remain well anchored. Now, away from the obvious COVID distortions and the Delta variant, the other categories, I'd say, were relatively well behaved. You've got food prices that remain somewhat elevated as the supply chain disruptions continue to plague some of the commodity markets. The medical care and rental housing prices posted trend-like gains. Housing inflation is going well, and it's definitely worth watching in the coming months. House prices have increased slightly and supply is limited. They say that we suggest the rent prices should rise as well because of that. I'd say so far that is yet to really be a factor in the broader inflation measures, but it's potentially a source of upside risk going forward. Headline CPI is definitely higher than core, which I talked about, running about 5.3% year over year. Supply chain disruptions in non-energy commodities have caused an unusually large gap to emerge between the headline CPI and the price of gasoline. You've got wage inflation, and that definitely depends on a number of areas. If you look at it, what type of business you're in is really the main one. For example, lumber was high, but it's back to normal now. If you look at all the data points, we don't see continued high prices. We think the gap around the 1.5% is probably the best estimate of the magnitude of the impact for the COVID-related disruptions that they're having on inflation at the moment. So where do we stand today? Now, this is an older slide, so some of these numbers have changed for 2021. But if you look at where we were, GDP was down 3.5% in the US. It was down almost 4% globally. Those numbers have certainly changed, whether we're at 5.5% or close to 6%. The 10-year Treasury has changed significantly, down originally to under 1%, and it's up now. U.S. inflation we've talked about. The other thing I'll talk about is S&P earnings growth. It was down 16% last year, and as of the date of the slide, it was up 37% in this year so far. So this is another last piece about inflation expectations, and this is the U.S. 5-year forward inflation expectations. So inflation expectations are simply the rate at which people, consumers, and businesses, investors like us, it's how much we expect prices to rise in the future. So they matter because the actual inflation depends in part on what we expect it to be. And if everyone expects prices to rise, say 3% over the next year, then businesses are going to want to pay prices or raise the prices at least by 3%, and workers and their unions are going to want to similar size raises. So all else equal, if inflation expectations rise by 1 percentage point, then actual inflation will tend to rise by 1 percentage point as well. The target where we're at is closer to 2.5%, between 2 and 2.5%. The Fed's mandate is to achieve the maximum sustainable employment and price stability. And so it really defines the latter as the annual inflation rate of 2% on average. So to help achieve the goal, they strive to anchor that inflation expectations at roughly the 2% number. So if everyone expects the Fed to achieve inflation of 2%, then consumers and businesses are really going to be likely to react when inflation climbs temporarily, which they have. If inflation expectations remain stable in the face of these temporary increases that we've been seeing, or if deflation if it decreases, it's going to be easier for the Fed to meet its targets. And so the bottom line, as you can see that I pointed out here, it's very, very difficult for inflation to increase over time. If the higher prices aren't expected in the future. So 5-year forecast, somewhere between 2 and 5%. Lastly, I'll end on this because we all have investment portfolios of some sort. If you are retired, let's start there, because I know we have a lot of people in Keiretsu that are retired. For the bond-heavy investors, if your portfolio is heavier on the bond side, regardless of how much you spend, inflation protection can mean the difference between depleting your capital or not. For those who are heavier on the equity, on the stock side, and you're spending a lot of money out of your portfolio, inflation protection certainly can help reduce the risk of depleting your capital, especially in hostile markets. I'd say like we're in now, really volatile markets. Some may view this as lower hanging fruit than spending cuts, as an example. And then lastly, if you are an equity heavy investor, retired, but you don't spend a lot from your portfolio, then inflation protection is probably less critical, though over time, because you are retired, it's going to be helpful. And finally, if you have some years left for earned income, if you're heavy on the bond side right now and you're spending more than normal, I'd say, inflation protection can certainly boost the probability of you sustaining those expenditures over longer periods of time. If you are a heavy stock investor with a high degree of spending, then inflation protection is, I'd say, less critical, but it still can have a meaningful impact on sustaining your expenses, especially in the case of hostile markets. And then if you're a bond-heavy investor and you're not spending a lot, inflation protection definitely can help improve the probability of you sustaining your expenses to try to minimize some of that volatility. If you're a stock-heavy investor with low spending, it's less critical. And so if you have any questions about this, feel free to reach out to me. If you have any questions about your own portfolio, please reach out to me. We're happy to take a second look, kind of like a second advice from a doctor, and just let you know what we think. But really appreciate the opportunity, Brianna, for you to give me a chance to give some updates on the market and on the economies as we see it.